I do encourage you to please access that and engage with that material also after this meeting itself. So I think that's enough on the process. As I said in the beginning, we do want to get to interaction and questions. To invite you to pose your questions using the chat function. You can also, by show of hands once we get to that stage, but we'll go through an initial round of presentations. I've asked Mr. Stefano Signor, who's the head of the unit for the European Commission on the Unit on Climate Change and Sustainable Energy, to kick us off on some initial remarks, and we'll then move through the researchers representing the African perspective, shall we say, emerging from our research. I'll then provide a short opportunity for Mr. Signor, if he wishes, to respond to some points that might have been raised during those presentations, and then we'll move into the Q&A session. If at any point there are, questions relating to structure or the process that we're going through, those can also be raised in the chat, and I'll address those. I think probably ideal if when speakers, when you're not speaking, to maybe switch off the video if there are bandwidth issues, but if it's working fine with your videos on, you're welcome to continue. So without any further delay, Mr. Signor, if you could kick us off.
Yeah, so good afternoon. I think I have probably an issue because I have, let's say, connected twice. So I have a very disturbing echo in my audio. So if you give me 1 minute so that I disconnect one of the two, let's say, connections, and I'm immediately back to you. So I don't know if perhaps you want some of the speakers to start already. Otherwise, give me 30 seconds, 1 minute, and I will be back to you.
Okay, let's give you a second. I just think since the presentations of the perspectives coming from the project itself that I've just described, since they're all linked in a way, it might be nice to run those in sequence. But if it turns out that it takes more than a few seconds, then we'll certainly kick off. And Olivia, I'll ask you to get us started. So let's just give it a few seconds, and if it's delayed further than that, Olivia, I'll pass on to you. Okay, it does look like it's maybe taking a little bit longer, and I don't want to lose too much time. Olivia, if you could kick us off. Olivia Rumble is a long-time associate of SAIA. She's a director at an outfit called Climate Legal that many of you, I think, would be aware of, and I'll ask her to get us started on the theme of COVID-19 and climate finance, green stimulus.
Thanks, Alex. And thanks everyone for joining us today. You would have seen in the news that we are calling this particular COP, or some are calling this particular COP, a climate finance COP. And so it's some of the issues we're talking about today are particularly relevant for the negotiations starting this weekend. And as Alex mentioned, what we've tried to do through this project is elicit different voices from across the continent and engage with them on what they believe some of the issues should be. And what's quite nice, and you'll see this in our report, is that a lot of these issues already dovetail and complement what negotiators are saying, particularly the AGN around Southern Africa, sub-Saharan Africa is too many SARCs, climate finance priorities for the COP. And the next few slides, I just wanted to talk you through one of the three legs that we had in this project. So as Alex mentioned, we have adaptation, we have COVID-19 and related response measures, and the third is private finance. And the fact that I'm presenting this one first is by no means an order of priority. There are multiple legs to this particular concept, but the reason we chose it is that COVID-19 presents some very novel entry points for new ways to discuss climate finance. And I wanted to talk through those a little bit and present very briefly what some of our participants felt around these issues. And so it's not, traditionally we speak about adaptation finance, quantum of finance, private finances as a standalone item. COVID-19 and climate finance doesn't neatly fit under those sort of subcategories of climate finance, but we feel it's a very important paradigm and sort of framing concept for how we approach some of the key African issues. So, and forgive me, you will probably be familiar with a lot of these numbers, or at least in your day-to-day lives have appreciated some of the financial and social stresses of COVID, but we know that food insecurity levels have more than doubled since the pandemic hit. It's estimated that 100 million or possibly twice this amount will be pushed into extreme poverty in the developing world, potentially by 2025 or 2030. In 2020 alone, there were 32 million additional people in sub-Saharan Africa that were pushed into extreme poverty as a result of the pandemic. And the latest report I saw from the IMF, and people are still looking at these numbers, but they estimate that GDP growth in Africa will lag substantially behind the rest of the world. So in sub-Saharan Africa, we think it will be about 3.6%. Rest of the world on average is about 14%, based on massive injections of stimulus measures, which I'll talk about in a little bit. We still don't quite know to what extent countries will be experiencing recessions. We know that there are a lot of global shocks happening because of volatility in oil price, etc. But in general, we expect GDP growth to be extremely slow. We know that the region has also had extremely limited access to vaccines, which has hampered response measures more generally, and the ability of countries to move to a more stable fiscal space. And when I say there's also a lack of fiscal space, I mean that a lot of sub-Saharan African countries are really crippled with debt burdens, and that existed over the past decade, but has been considerably exacerbated as a result of the pandemic. And so countries have less and less money to spend on priorities such as health, education, climate, etc. Which means that because of our elevated debt vulnerabilities, we don't have room to spend. And this has been exacerbated by a sharp drop in commodity prices, an immense contraction in exports, a loss of remittances into different countries, and unprecedented capital outflows. So as a continent, we've suffered extreme capital shocks to our economic systems. And in that context, we need to find a place to just talk about how climate finance, both national climate finance, as well as climate finance that African nations receive from developed countries, fit into that picture. And so if you've been following the news, you would have seen a lot of articles around debt forgiveness. The AU really prioritized this at the beginning of this year, talking about how, given the debt stress that African countries were facing, there should be a degree of debt forgiveness. You would have seen at the G7 that vaccine rollout has been a particular issue for African countries. I know that the South African President Cyril Ramaphosa was particularly championing this issue at the G7. And it's tied to a degree to how developed countries perceive and relate to emergencies and shocks within developing countries. And to that degree, and I've written on this a little bit, we call the COVID-19 pandemic a climate finance parable, because it's a crucible really of how African countries are experiencing sudden and extreme capital and social shocks to their systems, and how this is affecting not only our our national planning, our ability to spend, but also our global political relations with our neighbors. And it draws to the fore how aid is perceived and asked for during those particular shocks. So, if you read reports from UNEP towards the end of last year, they've noted quite considerable declines in climate issues across African countries, unsurprisingly, because they are focusing on pandemic response measures and redirecting finance flows. There's quite a deep concern, and we're still trying to figure out when these recessions may hit and the extent of them, but that these recessions may jeopardize national climate budgets. So we know from adaptation studies that most of the climate finance spend happening in adaptation, for instance, in Africa, is happening a lot from national budgets. And that jeopardizes the already dwindling resources that African countries have to deal with adaptation, because very little climate finance goes towards that particular issue. Most recently, AMCEN have also noted a concern that in the context of the pandemic, they're seeing less and less grant funding, and that the funding that is coming through, or finance that's coming through, is typically in the form of a loan, which is obviously less pressurable. There's interest rates to repay. There's typically conditionalities attached to it. So there's a lot of costs attached to loan. And this has been an African bugbear for more than a decade, where we've seen since about 2013, dwindling grant funding and more loan funding coming to the fore. In June 2020, and I've yet to see more recent estimates. I think the SCF is working on it, but there's an estimated drop of about 700 billion in climate finance, and that's a global figure of both public finance from developed countries, as well as private finance from private DFIs and MDBs and the like. And if you look at that figure as a total quantum, you can see the considerable shock that it's had to the system, because at COP26, we're fighting about 100 billion. So if we're saying that COVID has had a 700 billion impact in global climate finance flows, it will be a particularly important consideration for African governments to put forward their current position as a result of COVID, and to also explore alternative measures that can free up, for example, national fiscal space. So we're looking at a very, very unique situation where we have about 12 trillion US dollars circulating the globe that is being implemented by national governments to kickstart their economies. So there's a massive outpouring of money, more than we've ever seen since the 2008 shock. And these are good and important measures that governments need to take in order to stimulate employment, job creation, for companies to rebuild, to kickstart sectors that may have lagged as a result of the pandemic. But it also raises a very, very unique moment for this type of finance to also build back better. And I'm sure you've heard about that kind of language in newspaper reports. So when we talk about build back better, we're talking about relatively easy projects that governments can invest in to kickstart their economy. So shovel ready, for want of a better word. Things like low carbon infrastructure, low carbon mobility or transport measures, wastewater treatment plants, adaptation projects that include, for example, nature-based solutions, energy efficiency projects. So type of projects that you ordinarily see a lot of co-benefits attracted towards them. And in the beginning of the pandemic, we saw governments, particularly in the EU, channeling finance through those types of projects. In October 2020, and forgive me, I'm sure there's more recent figures, but the one I have at hand is that $866 billion was provided in stimulus funding to carbon-intensive sectors. So whilst we're talking about a 700 billion reduction in climate finance flows as of that year, at the same time, governments were bailing out fossil fuel sectors. And that led to a huge public outcry where particularly developing countries, as well as green green groups were saying that governments shouldn't be further entrenching climate vulnerability and risk by bailing out these industries, or at least this was the moment to start talking about conditionalities and those types of finance. So green conditions. You may have been familiar, for example, with the bailouts of a couple of the EU's aviation sectors. So different airlines were granted stimulus funding, and there was a lot of debate around whether those airlines, in consequence, should commit to net zero in order to receive that funding. Vivid economics, yes.
Just a quick prompt. I'm just watching the time. If you do want to get through to those key messages. Fairly soon.
I shall. Thanks, Alex. So Vivid Economics found that most recovery packages failed to mainstream climate considerations, and many reinforced vulnerability. In good news, the AU, through the AMSEN, has created this thing called the African Green Stimulus Program, which seeks to do just this, to kickstart African countries' economies, but through climate finance projects. So to build back better in a green way. But a lot of this program, if you break it down, requires both public and private finance to get off the ground. And so one particular ask at the COP would be for public finance to support the implementation of this particular program. Other issues that African countries are bringing towards the COP include debt forgiveness, the reallocation of special drawing rights through the IMF. You may have read about how the IMF is looking to, or has made a massive 650 billion reallocation of SDRs. And there's a question around, can we rechannel those to developing countries in order to give them the fiscal space to spend on climate issues? Some countries haven't done that, for example, the UK, and they're receiving a lot of criticism around that. There's a potential for debt for climate swaps, so debt forgiveness in return for African countries to take on more climate ambition. And for all this to all get off the ground in African countries, we need to not just have an Africa-wide green stimulus program, but we need to mainstream climate into stimulus packages. And we also need to scrutinize our support measures for the fossil fuel industry. And lastly, we're looking for, obviously, public climate finance support for the African Green Stimulus Program. I'm not going to read through all of these. I'm just going to put them here so you can get a sense of them. You can unpack them in the report that Alex gave a link to. But you can see that when we were workshopping this with other African participants and stakeholders, they echoed support for all of those goals, but they said it's important for us to also be looking at our COVID-19 response in the context of a much broader global picture. So we need great ambition around the 100 billion goal, a global goal in adaptation finance, capacity for African institutions, capacity building, sorry. We need African countries to finalize their NDCs. There should be a greater diversity in climate finance instruments. We need to prioritize loss and damage, prioritize financing approaches with multiple development co-benefits, mainstream adaptation, have a more ambitious narrative, and use grant finance to catalyze projects. And so thank you for your time. I'm going to pass it back to you, Alex. But if you do have any questions, please relay them in the Q&A.
Perfect. You know, it's always a challenge because the material is so rich, but I've got to be thinking about allowing sufficient time for engagement because I'm sure there will be questions. Now, Mr. Senor, I wonder, since we've now started with the presentations that speak to the key messages, I think it would be reasonable to maybe run through those and then,
sure.
then have your response at the end.
Absolutely, yes. Perfect.
Well, then I'm going to hand over directly to Olufonso Somoran, again, also a long-time associate of SIRES. He leads on climate and green growth for the African Development Bank in the East Africa region. Olufonso, if you can take it away, do keep an eye on the time for us, please.
All right, thank you. Thank you, Alex. Good afternoon, colleagues. Thanks to everyone joining this conversation today. Olivia, thank you very much for setting the scene. One of the key questions was very much about adaptation finance. And I think as we put a framing, as we call this particular COP26 the Climate Finance COP, one key issue for the African continent is the question of adaptation. particularly adaptation finance. And I think it's very instructive to emphasize the fact that over the years, there has been this huge disparity between the total financial flows towards mitigation compared to adaptation, despite the fact that adaptation remains a priority for Africa. And we don't just say that because, we say Africa is vulnerable. The truth about it is 7 out of the 10 most vulnerable countries globally are in Africa. And vulnerability and ultimately the response, which is adaptation, is very critical for the African continent. And so we did a number of diagnoses, just very looking critically into what are the barriers to adaptation finance in Africa. And I think we came up with a number of recommendations. Again, I'm going to refer you to the discussion paper, but I'd like to just structure some of our key findings around 3 areas. And I'm hoping that we can have additional time later on to discuss about them. Now we understand why this adaptation finance, the gap, obviously the gap between mitigation finance and adaptation finance in Africa is there. And for a number of factors, some of them are very structural, quite endemic to the institutional setup within the African countries, but others are actually quite external as well. But then we realized that, it was very important to start out with the first key point, and that is the fact that over the years, many African countries have developed this National Adaptation Program of Actions, so NAPAs. From the age of NAPAs, eventually we moved to National Adaptation Plans, NAPs. And now we have NDCs, and then you have a significant focus of adaptation within the NDCs. But why you have all of these and consider them to be policy frameworks that are very clear about the type of projects that will qualify for adaptation, we've never had anything called a National Adaptation Financing Framework. So the starting point in this conversation is to explore the idea that many African countries themselves need a financing framework that is very specific to adaptation. And what is this framework going to do? I think it's very important to be able to understand. By the time you're unpacking the barriers to adaptation, which we know, both theoretically and practically on the ground, you develop a financing framework that seeks to answer and address those challenges. So we're talking of a financing framework that is very clear about the diversity of financial instruments that you can use for adaptation. Today, as we speak, if you take a quick inventory of all adaptation projects financed across the continent between 2014 and 2018, 57% of them were through loans, 42% were through grants. And so most of adaptation projects are limited to loans and grants. We haven't explored opportunities in equities, in guarantees, and in new innovations. And I think for me and for us, this is very limited. So it's important to understand, to look at what is this new, what are the opportunities, what are the kind of instruments we can use for adaptation. This financing framework would also include elements of different sources of financing. And in most of the loans and the grants are usually external, looking at, to the external climate funds or bilateral investment. But what about domestic resources within the country? So we have an opportunity to expand our thinking around financial sources beyond the traditional MDBs support, the traditional bilateral or climate funds, to look into new areas such as private capital flows, domestic resources within the country. And this very important as well. It's also important to understand that the financing framework should include elements of building project registers, monitoring frameworks, and as well as elements of revenue and making economic cases. It's very important, and we were very bold in our recommendations to encourage African countries to think critically on the notion, on the idea of a national adaptation financing framework. The second point, and this is also linked to the first one, is the fact that when you look at a lot of the NDCs that have been submitted by many African countries, while the adaptation is very clear in terms of the list of projects, the objectives in terms of the business cases, in order to be able to crowd in private sector investment, it's not very, it's not satisfactorily done. So particularly, not just list of projects, not just list or give ideas of opportunity, adaptation of project opportunities in the water sector or in the agricultural sector, but going further to make a business case, an economic case for investing in adaptation. That is very important. And this is not going to happen by the external donors. It's something that has to take place within Africa by a lot of the ministries and the institutions leading adaptation programs, because it's very important that we're able to attract private capital. Globally, barely $500 million out of $30 billion going to adaptation comes from private sector. And that is a missing opportunity. It's space that we need to take advantage of. So it's very important that we make a business case, an economic case for adaptation. And that means we must be able to sell the notion of adaptation benefit, and to justify every return on every $1 of investment in adaptation projects. Lastly, the third point is also, since we're talking about financing framework, is to be able to emphasize that we may be missing out on some innovative financial products that can really work for adaptation. And Olivia touched on a few of them, and it's very important. Today, we're beginning to talk about climate resilience bonds. These are innovations that can work for adaptation projects. We're talking about debts for climate swaps, and they're already ongoing, because in Seychelles, this was something that was tested and it was very successful after the 2008 global financial crisis. And so we're also talking about innovations on inequities as well. I told you about how most of the investments, financial flows towards adaptation are largely around loans and grants. We need to take adaptation out of the notion that it's a public good and make that business case. And I think that's very important. Lastly, just a part in short, adaptation is everybody's business. We can't keep it to the responsibilities of the public sector alone. It's everybody's business, from the research organization and to the institutions, both state and non-state, to civil society. And that is very important, because the moment it's framed as everybody's business, we can expect that additional capital will flow into it. We cannot look at financing in an institutional vacuum. Financing is very much nested within, the overarching state-society relationship and also operating systems in our country. So it's very important to be able to scale up that awareness that it's everybody's business. There's a role for the private sector, there's a role for universities, there's a role for youth entrepreneurs, there's a role for the government, there's a role for development partners. And I think that's very important to be able to scale up the financing that we need. I'll keep it here for now, Alex. Thank you.
Excellent, thank you so much. I want to use as little time on my side as possible, so I'm going to go over directly to Mr. Jonathan First. He's the Managing Director at GFA Climate and Infrastructure, and he participated in these discussions and has also written a brief for us on the role of the private sector in climate finance.
Good afternoon, everyone. I hope you can hear me. So I just want to start with some facts, which is quite interesting. So Climate Policy Initiative has just finished mapping climate finance flows for the 2019-2020 period. And they identified about $628 billion of climate flows. So that's the world as a whole. Now, in respect of Africa, less than 3% is flowing into Africa. So that's around $12 billion. So of the 628 billion, 12 billion. Now, if you look at where those flows are coming from, about 30% is what we call concessional, DFI, multilateral based, and about 70% is private sector. So the private sector contributions are growing, which is good, but very little of that is seen in Africa. What's even more upsetting, I suppose, and this goes to Alfonso's talk, is that only about 12% of that 12 billion goes towards adaptation. So that's less than 1.5, 2 billion. So the figures are depressing. And the question is, and the question that was posed to me is, why is this the case? So my argument is that funding is available. Yes, we need a lot more funding in terms of climate finance, but it's not getting to Africa. And why is that the case? So I talk about the 6 pillars, the 6 enabling pillars, as to why we're not seeing the kind of climate finance flows to this continent. And I'll go through those at a very high level. They are going to be in the paper where they'll go into much more detail. The first is that everything we do in terms of funding must align to the UN Sustainable Development Goals and what we call the ESG impacts. So those have become the benchmark for funders, whether it be public or private sector funders, and it includes, of course, the development finance institutions. So there must be an alignment with the SDGs. And obviously, the more SDGs, the stronger the case for funding. So that's pillar number 1. The second pillar is that Africa is not a homogeneous continent. We have 54 countries, okay? But more importantly, the way that funders look at the continent is in terms of 5 regions. That's North Africa, West Africa, East Africa, Southern Africa, and Central Africa. And they very much target those on a regional basis because of course politics, economics, and business are very much intertwined in those regions. So that's the second important thing, is we need to very much take a regional approach when approaching funders, particularly with within climate finance. The third one is that there are only really 2 sectors that I believe count in Africa. The one is infrastructure, and the other one is SMEs. So this entire continent is very much founded on those two pillars. So I'm very much going to talk about infrastructure because that's the larger one. And the reality is that impact funds like infrastructure. They prefer it as an asset class. They prefer it as an asset class because you've got identifiable assets, and also you've got cash flows coming from those projects. So that's it's very attractive to funders, particularly private sector funders, is infrastructure. The other thing that's important is, of course, is that infrastructure is always going to be a priority for governments in Africa. So I think that's the sort of third pillar, is that infrastructure, the importance of infrastructure as an asset class. The fourth pillar is that only 3 of the 54 countries in Africa are investment grade. So you cannot apply normal investment criteria in terms of the continent, because everything is sub-investment grade. So I believe that as a result of that, we need to look at everything much more on a project finance basis. And this is what the funders are doing. They're largely ignoring the investment rating because it just doesn't help, and very much focus on a sort of more of a project finance approach in terms of the way they structure finance. So I think that's very important as well, to recognize that we need to take a far more of a project finance approach. So that's the fourth pillar. The fifth pillar is very much up to us as people living on this continent. We need to be responsible. We need to create the regulatory and the legal environment to give funders the confidence to put money into our countries. Okay. There are a lot of reasons why they should be putting money into this continent, but we need to also look at ourselves and make sure that the regulatory and the legal environment that governments create is conducive to the funding. The other thing is we need what I call is the political will. Okay. The political will, and that is very much at the moment defined by the national determined contributions. So once again, it's becoming a benchmark for climate finance is a country's commitment to its NDCs, which is very much creating the form, not only the form, the substance around climate finance into those countries and obviously into the regions. The next pillar is that the use of credit enhancement. So we talk about the concessional funding, the funding that is made available from development finance institutions, from multilaterals. We must use that funding to catalyze private sector funding. I think that's vitally important. And the higher the catalyzation, obviously, the greater amount of private sector funding we will get into the continent. So we need to be very mindful of how we use concessional funding. And this is well documented. And lastly, I talk about private sector themes as the last pillar. And these are all around what we call bankable projects. So the other criticism, and the other thing you'll hear a lot about why climate finance doesn't flow to the continent, is that we don't provide what they call bankable projects. In other words, projects that funders can make an investment decision on. And to me, that is actually the greatest challenge. I mean, the others are all important. One of the greatest challenges is we're not creating a bankable pipeline of infrastructure for funders to invest in. And that goes to both the concessional funders and the private sector. The other thing, of course, is impact reporting. This is becoming far more important. It's an enormous challenge, not only in Africa, but around the world, is that funders are now going to insist more and more on being able to measure and report on impact. So, as I said, it's got a long way to go. It's probably the biggest challenge within the ESG impact framework, but certainly it has to be developed if we're going to see increased flows, climate finance flows to the continent. So that's very much the pillars, what I talk about, the pillars, the enabling pillars, which will accelerate climate finance to this continent. Thanks very much.
Thank you so much. Mr. Sino, I've already introduced you at the start, so I'm going to hand over directly to you.
Yes, absolutely. And apologies again for my small technical issues, but it was really impossible to talk and listen to myself at the same time. Look, very briefly for the benefit of time, first of all, thank you for this opportunity to discuss this very well drafted report, which highlights a number of recommendations and really focus on a number of key issues. The one that we have discussed, how to mobilize private sector finance in support of climate action, the relation between, let's say, climate action and the post-COVID stimulus measures, and the issue of adaptation finance that, as we know, is very relevant for the African continent. So let me start first from saying why all this is important. It's important because on the one hand, we know that cost for addressing climate change, including in the African continent, can only increase because of the worsening climate change impact. On the other side, the money will not increase indefinitely. And therefore, we need to use all the possible resources that are available in support of climate action. And that is why it is important really to capture, let's say, and bring in the direction of increased climate action, increased flows of private capital. So this is really key for this conversation. Now, let's start from the public side, let's say the public money that in any case, irrespective of whether it is used in form of grant or to de-risk, let's say, the mobilization of private capital, in any case, it has to be there. So on our side, as European Union, we already are at the forefront of contributing to the public climate finance. We mobilized in 2019 as Team Europe, so EU institution and EU member states, some $22 billion US. And this was an increase of 7.4% as compared to the previous year. So this was in 2019, because we still don't have the consolidated figures for 2020. And in particular, in the Commission, we are moving from 20% of the previous financing framework, 2014-2020, to an increased spending target on climate finance of 30%. So this is roughly 24 billion euros over the 7 years starting in 2021. But recently, in September, our President von der Leyen announced an increased pledge for climate finance, adding 4 billion to this already quite big amount. So the total is 28 billion euros for the 7 years. So on average, more or less 4 billion euro per year. So this is, if you want, the public side. And what I can say on our side, we have a quite fair balance between adaptation and mitigation. In fact, we have a slightly, let's say, a slight predominance of adaptation, more or less 55 to 45% in terms of our portfolio, at least. Now, of course, as I said, this is not sufficient. We need to mobilize financial flows that comes from the private sector in support of climate action. And this will happen in the framework of our what we call EFSD Plus, so European Fund for Sustainable Development Plus, which basically will be able to count on a potential of 40 billion euros of guarantees that we will put available to financial, let's say, the DFIs, development financial institution of member state, other international financial institution, to propose, let's say, investment in a number of sectors, from agriculture to infrastructure to digital to renewable energy, etc. And climate action will be mainstreamed throughout these windows, so as basically the contribution to our climate objective will be very important. And this brings me to the issue that was also being mentioned in the last intervention and through the different intervention of, let's say, making sure that our de-risking instrument can also boost let's say, project contributing to adaptation. Because what we know is that project focusing on mitigation actions are much more developed. Let's think renewable energy is one of these areas, but there are others too. While for adaptation, this is more difficult. I can tell you that also through the conversation we have with the financial institutions, there is a lot of appetite to engage in this area. Everybody understands, recognize that this is a priority. What is missing is a sufficient number of bankable projects. And this is a bit the mantra. Money is not an issue in terms of, let's say, there is capacity to support financially those kind of projects coming from the private sector, but we don't have enough. And here, I think, without having the time to delve too much, of course, for the benefit of the conversation, I think there are a few issues that we need to look at. Of course, there are issues that really have to do with local conditions. You know, the fact that perhaps legal frameworks are not clear for land management, for you know, if you have a forestry project, ecosystem projects, water, etc. You need to have clarity on a certain number of things if you need to have a project running through 20 or 30 years, or it can be linked to the difficulty of, let's say, putting in place a project which have to do with the provision of public services. This can be the case, for instance, for waste, but also for other local services. So to say that this is an area where there are no silver bullet, but just to say that there is an understanding that this is an area where we need to focus. And on our side, what we are ready to do is, for instance, to mobilize more technical assistance, to perhaps, you know, increase the risk we normally take on this kind of project without, of course, taking out entirely the risk that needs to remain for the private investors. And to identify also a bit of innovative tools, for instance, in the area of agriculture, you know, insurance mechanisms where we can subsidize part of the premiums to build, let's say, on a few experiences that have been made so far. But let's be honest, it's not easy to go to scale and to, you know, let's say, encompass all the different needs that are out there. Let me perhaps close with one call here, which has to do with the triple crisis that the African continent is currently facing. The first one is the COVID situation. And then, of course, the debt and macroeconomic conditions, which of course, put a heavy burden on a number of African countries. And then, of course, the climate. And here I have to say that we need to avoid working in silos. And I think this is also relevant for the adaptation community, because we need to be able to, let's say, encompass all these different needs and policy objectives at the same time. Create decent jobs, so support the jobs and growth agenda, counter inequalities, support social protection, education, and at the same time, as I said, address adaptation, resilience, disaster risk reduction needs. So we really need to think what are the kind of approaches that will allow us to address all these different issues in combination. Because if we have policy objective which will be perceived as countering each other or opposing each other, we will not manage to have sustained momentum to address those in an effective, in an efficient manner. So I would stop there, as I said, for the benefit of time, but happy to answer a question you may have. Back to you. Thanks.
Thank you so much. Thank you so much. There have been a few questions coming up in the Q&A in the chat function, and we might turn to those in a moment. But I maybe want to take the opportunity to also prompt the audience, since we're framing this as a EU-Africa dialogue, if there are specific questions related to EU's role in climate finance, the EU-Africa relationship, I would encourage you to raise that either by a show of hand or putting the question up in the Q&A. Some questions have gone up already, and I'll quickly turn to those. There have been some responses, written responses, but Olivia, I saw that you've already started with a written response, but not everyone's going to have sight of that. So maybe you just want to recap the answer that you've given there. There was also a question, Alfonso, to you around the fact that if we all agree that climate adaptation is a priority, then who is it who needs to be convinced of the economic case, and shouldn't we be building this economic case together? So maybe you can take that one on for us. I see you've written the response as well, but perhaps for the broader audience. And then while those two responses get going, I would also then invite Jonathan and Stefano, if there are further thoughts or comments that you want to make based on the other presentations, please go ahead. For the rest of the group, if you have questions, please put them up in the Q&A function or the chat.
Super, thanks, Alex. And thank you, Jacob, for your question. I think it's a good one. And this was definitely something that came up during our workshop. So your question was around how can we make climate data more accessible, especially at a national level, so that when we allocate funds, we have confidence that they'll be used to finance effective solutions. And in my answer to you, and just for the benefit of everyone else, I said, you've touched on one of the key issues around finance is that it's still quite murky. So we don't have, for example, an agreed global methodology on what is and isn't climate finance. And we're still debating the definition. The African Union, the AGN, African Group of Negotiators, put forward a position, for example, last year that they felt that private finance or anything that involved a cost associated with it, anything other than grant finance, shouldn't count as climate finance when you're talking about the $100 billion goal. And we're still coming up with an agreed definition of climate finance, as well as a methodology of what should count and how we should count it. And that has knock-on effects as well on national reporting around climate finance. So once we have an agreed methodology on how to count it, national governments can then look at their coffers and go, well, we've received this much, we're tracking private flows in this way. I'm not saying, a lot of countries are already doing that, but there's no standardized way of doing it so that we can really compare apples with apples. So we should be pushing for more agreed methodologies and a lot more transparency around climate finance. We should be asking for climate investment plans, We should be asking governments to provide a bit more transparency about what they're spending, what their project timeframes are, which are their priority projects, that type of thing. And that will give the mobilization that you're asking for within the youth to know which areas to focus on, which priority projects governments are pushing for, etc. So it's a great question and a very important point that we're going to be dealing with at the COP.
All right, thank you, Olivia. I think from Dais Naidu about who needs to be convinced by the economic business case. I mean, the truth about it is, we know that on the African continent, when you look at the economies of many of our countries, they're very much in the sectors that are directly impacted by climate change. You know, agriculture, even trade in commodities, energy, and the likes. And what is important is we don't look at adaptation just because we're responding to probably a one-off drought. No, we must see adaptation as something that is very critical to growing and developing the continent. And I think it's very important, particularly as we move towards a very sustainable development pathway in Africa. But again, it's also important to understand that, you know, this adaptation is you're first person, the first to benefit from it before you can actually say that you are being resilient. You know, it's not just the individual, but we're talking of businesses. We're also talking of economics at large. So who needs to be convinced? Both the leaders and the people of Africa need to be convinced, but also the partners, the global partners as well, need to be convinced. And so the responsibility then falls on us to be able to make sure that we present adaptation as an opportunity to deepen our business opportunities, it gives us a space to look at it differently beyond the way it's always been done. So, and that's why when we talk about adaptation, usually talk about grant resources going for small scale adaptation projects. No, when we do infrastructure, we must do it through the lens of adaptation. When we do energy, we must keep in mind that there are changes in the climatic system that will affect our development in the long run. So that's upskilling, that's framing, it's very important for us. And the business case as well is, since we're talking about finance, it's also to be able to see, and this links to the question around if we have succeeded pretty well with mitigation, what do we need to learn from mitigation that can be useful for adaptation? I think we've got a lot to learn from mitigation. National level, you're having some countries where if you track climate finance over a period of time, 70 to 80% of the total capital flow is into mitigation. Now, we must also understand that adaptation may have some natural, challenges. It's very complex compared to mitigation, but the differentials have been around the fact that, we were able to bring the unit of currency of mitigation to carbon emission reduction. And we've not been able to create a similar currency for adaptation. And so the push towards adaptation benefit, looking at it as a benefit, as opposed to an individual project, is very important. Even if we cannot quantify it in the moment, we're able to understand the qualitative benefit that comes from that. Last point that I want to say, and this is an example. Think of a region that has a forest, that produces a natural water that a bottling company may need to be able to produce, let's say, Coca-Cola. And think about the fact that, the science is clear that the more you keep this forest together and conserve it, it does have impact on the quality of water coming out from that forest. And a partnership with a private company that depends on this water for its business is basically, something within the whole framing of adaptation. At that point in time, there's a business case to say, should we keep this forest or should we sustainably conserve this forest? We have an opportunity to assure this private company of the ecological services. And so the notion of payment for environmental services or ecological services, they're there. And the moment we're able to tie that to adaptation opportunities, I'm very sure that, we slowly begin to make that case of adaptation benefit, as something that there's an opportunity to invest in, and the returns are quite significant. Thank you.
Excellent. I'm going to put forward 2 or 3 more questions that are coming in through the chat, and then I'm going to hand over to Mr. Senor, and we'll take it as it goes then. So, and I'm sorry if I missed some, but I'm just trying to get a flavor of some of the questions coming through. A point from Stefan Karakesi around the work on the Beira Corridor project. That's linking Mozambique and South Africa. No, sorry, Beira. I'm thinking about the Maputo Corridor project, the Beira Corridor project. Anyway, one of the key findings, the benefits of relatively low-cost input was streamlining of the border documentation administrative process, and that was key to ensuring the viability of the infrastructure projects. So are there lessons here for developing better quality, climate-friendly infrastructure projects in Africa? Might there be a case for placing more emphasis on sorting out regulatory and administrative barriers to higher quality, bankable, climate-friendly infrastructure investments? Let's leave that there. Next point, Amy, to do regarding bankable projects. How can we address the fact that smaller boutique projects, but with ESG co-benefits, may be missing upfront finance and may struggle to meet, due to the fact that they struggle to meet the standards required for international financial support, also considering high transaction costs of measurement and verification. And then Simon Fremantle, just checking in, Mr. Senor, again on to what extent there is support or specific support or alignment between EU's position and the Africa climate finance position at COP26. You may have addressed some of that to some extent, but maybe just to zero in on that, if you would. And then, of course, after Mr. Senor, Jonathan, if you want to have a few words, maybe something that's come out of the comments or the other presentations, and then we'll go over to Olivia and Adefonso again. So, Mr. Senor, if you'd kick us off.
Yes, of course, yes, absolutely. No, look, just to perhaps answer some of your question and also reiterate some of the points I made. As I said, on the public side, the public finance side, of course, we cannot be satisfied about the fact that we are the #1 providers of climate finance, because collectively we still haven't managed to reach the 100 billion. So of course, as I said, we have made recently an additional pledge. Other partners are also preparing or making pledges, and we hope that this will bring us very close to the 100 million already now, and in any case with the hope that somewhere next year or at the latest in 2023 we will manage to achieve the 100 billion. So this is, let's say, in any case our collective obligation, and of course, as I said, even if this is achieved, and within this framework you have, as I said, a fair balance between adaptation and mitigation, and the prioritization of least developed countries, small island development states, etc. In any case, grant money will never be enough. That I think is one of the things we need to accept. I mean, to cope with the exponential amount of resources that are needed to address all the adaptation challenges, including in the African continent, public money will not be enough. So the question is how to use the very significant amount of private financial resources that are looking for good investment. As I mentioned already, some of the difficulties, as I said, overall there is appetite to channel more resources in this direction. I think on our side, what we're trying to do is to look at our, let's say, toolbox and to see whether we can design frameworks which are more specific to these needs. As I said, perhaps, you know, to give a certain tailored approach to if it has to do with ecosystem services, with forestry, with climate smart agriculture, etc. So we are looking into that. So on our side, we are ready to engage more in this direction. And of course, there is also an issue which has to do with, let's say, the risk profile of the relevant financial institutions that needs to adapt their, let's say, internal way of working to what objectively is a relatively bigger level of risk for certain kind of projects, simply because, you know, perhaps you need to span over a longer period of years. You know, if you do doing a project on forestry will probably take 30 to 50 years to let's say be economically viable, while perhaps on renewable energy, on a solar mini grid, it can be 15 years. So these are differences that are objective, but that require, let's say, relevant financial institution and financial actors to adapt their way of working in order to address those kind of needs. And of course, there is work to do also on national and local level, as I said, because sometimes even when, you know, the conditions would be there to have project in certain areas, this does not happen because of issues related to land rights or to legal frameworks that are not necessarily conducive, regulatory issues that are not necessarily conducive to attract investment. So there are different things to be looked at, but let me just conclude by saying that this is an area where we are really willing to focus and hoping that our increased capacity in terms of de-risking private investment can serve the purpose of really pushing more private, let's say, finance, private capitals into those areas, and in particular in the African continent. Back to you.
Thanks, Jonathan. I think we're in the phase now of probably final thoughts, as we're going to be closing around 15:15.
Yeah, I just want to comment a little bit on why adaptation is disproportionately low. So whenever I look at funding a large infrastructure project, I use what I call the funding spectrum. So concessional debt, let's exclude grant, but let's say concessional and private sector needs to be repaid. I mean, that's the reality. So if there are no cash flows to repay concessional or private sector loans or investments, there is no funding. So the difference between adaptation and mitigation is that it's far easier to identify cash flows, dependable cash flows, from a mitigation project than from an adaptation project. So if you look at the Article 6 mechanism, the ITMOs, it's all around mitigation because you can measure the reduction in carbon emissions. You can't really measure as easily the amount of waste, plastic that's recycled, or the amount of kiloliters of water that is reused. So that's the big dilemma, is that the cash flows from the projects. So when I look at a project, whether it's mitigation or adaptation, I very much plot it on this, what I call the funding spectrum, and then build the structure around that. In other words, how much concessional debt you need, how much private sector impact, and then if grant is available. The other thing that's very, very important is I believe that grant funding should not be used in a sustainable long-term structure. Grant funding should be used for technical support, to take projects from feasibility to bankability. It should not be built into, as I say, a financial structure. Financial structure should be limited to concessional and, of course, private sector. And there is very concessional funding available, like the Green Climate Fund. I was involved in an application there. So it is available. But once again, I must stress, you need to understand the cash flows from those projects. if you're going to have any chance of funding the projects. And that's why adaptation is at a disadvantage. It's just the reality. Those are sort of my comments. Thanks very much.
Very good. Olivia, maybe we could go to you and then to Alfonso.
Sure. So just looking at the questions here, I think there's some commonality around how do we get people on the ground, particularly vulnerable people or small-scale projects, to get better access to finance that's available. And there's a lot of answers to that, but some of the suggestions that came from our workshops with various stakeholders was we need to get more accredited institutions across the continent. So under the Green Climate Fund, the GCF, that gives most of the funding, and that funding is usually typically channeled through an accredited institution, such as the AFDB or the DBSA, or sometimes it's directly from the GCF. And what stakeholders are looking for is to see more of those African banks and development institutions accredited under the GCF, so that they in turn can create more direct links to citizens with small or micro projects looking for finance. So that's been one of the asks. Another, I thought, quite novel suggestion was to have programmatic projects. So I think might have been Lorato asking, how do we get very small scale projects off the ground? Sometimes there's strength in numbers. So to duplicate those projects across different areas in the same way, and then to group them as a programmatic application for funding is one way to kind of reduce the transactional and other kinds of costs. But there are some interesting suggestions coming out, and be really interesting to see what happens in response to the EU's, to the developed world. I think is it Germany and Canada that are putting out their climate finance target early this week. And it will be interesting to see what the response is from the developing world, particularly to some of the issues we're talking about today. Alfonso.
Well, thank you. I think in the interest of time, it's just want to close with one point, and that is the fact that unfortunately, the way we do our counting and the measurement systems or what goes into mitigation and adaptation, it's unfortunately very much skewed towards the advantage of mitigation. I take, for instance, an energy project. So if you see an energy project that says renewable energies, solar powered pumps, even though it's easy to say the number of emission reductions so you can get from using solar power pumps, that's at output level. The outcome level is that the solar power pumps, it's probably for irrigation in a semi-arid region to increase food productivity and achieve food security. And unfortunately, at that point, an energy investment that is really creating an enabling space for achieving adaptation on the ground is counted as mitigation and not necessarily adaptation. So there's this layer of we stay at the simple measurable metrics, and that is carbon emissions, and we haven't been able to push the boundary of how do we allocate quantitative value to benefits, and that's where adaptation has suffered over years. Lastly, it's also very important that in the African context, we don't look at mitigation for the sake of mitigation. More than ever, we must look at mitigation to the extent that it drives and propels adaptation on the ground. So I don't look at infrastructure or transport only in the light of emission reduction. We must say it. How does it facilitate economic livelihoods? How does it facilitate, local economies and innovations in new technologies that are driving the resilient outcome of the people? So there's a shift away from output level to outcome level. The actions, the impact on the ground, as opposed to just the emissions that we're reducing. Thank you.
Excellent. Thank you so much. We're slightly over time. We've been saying, you're referencing the time constraints all along. Obviously, in a forum like this, we're scratching the surface. We are, I think, stimulating some ideas that we're not able to explore fully in a discussion like this. So I do want to encourage you to engage with the material. I've provided some links in the chat. but all those links come from the SIRE website. So I invite you to engage with the SIRE website as a starting point. I will put my email in the chat, but you can also contact us through the website. And I know there have been some questions or requests for contact details of the speakers. So I don't think there's time to address that now, but again, contact us at SIRE and we will assist. We're happy to assist. I want to give a thank you to everyone who's participated, who's raised questions, who've engaged with us. Particularly want to thank our speakers, most of which have come along the road for this project that we've been implementing over the course of the year. But of course, a very special thank you also to Mr. Senor, who's been able to give us a really kind of detailed insider's view of the European and the European Commission perspective. So thank you, everyone. And with that, I'll close this meeting.
Thank you. Good afternoon, all.
Thank you,
Thank
everyone.
you. Have a good day.
Everyone.
Bye.